All right, everybody. Well, I'm glad. Hopefully, you guys, I wish I could see you. Hopefully, you're not sleeping, don't have headaches, something like that. We're going to finish up our discussion of equities. So we've talked a lot about how to construct a portfolio. We've told you all about the things you should do and the things you shouldn't do. Well, I think this is a really interesting section. We're now going to show you what does a good portfolio look like. So I think that's really important. Modeling seems to really work. So let's talk about what is a well-constructed portfolio and what does it look like. So first thing, it has a clear investment philosophy. We're going to buy stocks that are overweight this factor. We're going to sell stocks that are underweight this factor. Or if we can't sell, we're just going to avoid these altogether. We also have a consistent investment process. We're not spinning a roulette wheel every time we make a decision. We have a clear strategy, thought of advance, and a clear process. We also talk about a well-constructed portfolio addresses risk and the characteristics that are in my possibly prospectus or my instructions to the client. This is how I'm going to manage your money. This is what I'm going to do. This is the risk that I'm going to keep up with. Then, the other thing that we're going to keep about, I'm going to figure out a way to achieve your desired risk exposures and your returns in the most efficient manner. If I need to use passive funds for some things, I will. If I need to use active funds for other things, ETFs, index funds, hedge funds, alternative investments. Again, this is all geared in optimizing your portfolio in the best strategy to meet the client's objectives and constraints. And then the other thing, I know we talk a lot about cost, but there's a reason for this. If we are only going to generate 6 to 8%, if the economists are right going forward, if you're charging 2% operating cost, that's a lot of money for a client, and you need to be able to justify why you're charging 2%. And if you are paying too much or in a strategy that's inappropriate for a client, shame on you. Okay, so the other thing, we're always worried about efficiency. Just like any other business, our business is money managers. How efficient are we? So guess what? And this is something that I learned really quickly. I was only going to hold around 30 or less stocks. So guess what? I was going to achieve the risk exposure of my factors, what I identified to my client, and I wanted to do it in fewer positions. Because again, every stock that I bought, it was a trip to the company. It was a lot of analysis. Every trade I bought, there were direct costs, indirect costs, taxes. Every time we touched a stock, it was expensive. The other thing I need you to think about, let's think about volatility as measured by risk. And let's also think about active risk. How much risk is preferred in the portfolio? And the other thing that I want you to think of, given similar risk, cost, and manager skills, the portfolio with the highest active share is preferred. Because again, we're talking about active portfolio management. If you're a closet benchmark fund and your portfolio is 90% correlated to the S&P 500 and you own just a couple stocks that are not in the S&P 500, why are you charging your clients so much money when they could go to another company and pay 4 or 5 basis points? You're not looking out for your client like you're supposed to be doing. Now, the last part of our discussion today, and we'll talk about this much more in alternative investments, but I want you to understand the difference between long-only and long-short investing. You think you know this, but I'm going to challenge you. Do you know these in a way that you could answer a constructed response question if it just so happened to appear in the morning in your exam? So let's think about this. If I'm going to choose a long-only portfolio or I'm going to go into a long-short portfolio, it's got to be of things that we have to factor in. The first thing I want to talk to you about, costs. It is extremely expensive to hire fund managers to go long and short in the market. Oftentimes, you'll have some managers that specialize in going short and some that go long. There are some shops where the same team make both choices, but I've always found the teams that seem to be a little bit more successful in this, they had experts going long and going short. We also have to talk about transactional complexity. It is harder to go short. In fact, it might be illegal for your firm to go short, or your industry that you're in, or your company. So there's not as many people in the short side of the market. Now that might mean there's more inefficiencies, because again, a lot of investment banks and high quality shops and insurance groups, they can't go short. The other thing that I need you to think about, capacity and scalability. Again, a lot of these shops that go short in the hedge fund space, they're small shops. They don't have 20,000 employees. So your capacity and your scalability is going to be really big. And then the other issue that I want you to think about, legal issues. Hey, if you buy a mutual fund, you're long only. Not too big of an issue there. But if you start going short and making more complicated strategies, you're going to start running into legal issues, and the due diligence that's going to be required to understand these more complicated strategies can get very, very expensive. Okay, one of the approaches to the market, people take long extension approach. Well, there's a lot of confusion. What is a long extension approach? All that I want you to think about, these are preferred by investors. They want 100% net exposure. So a long extension strategy is 100% net exposure. This means you can compare it to a long-only fund as well. But the thing that's different about it, they might have an overweight and a short position. So they might have a long position of 130% and a short position of 30%. So at the end of the day, what's happening, they have a net exposure of 100%, but you are getting some short selling, some long selling. You're getting both, but you're still 100% net, and you're not getting the overweight to long or the overweight to short. You're getting 100% exposure. That's why an appropriate benchmark for a long extension strategy is a long-only strategy. Okay, market neutral. This is one of my favorites. So take that systematic risk, whatever it is, let's say it's beta, and you're going to go long and short, and you're going to remove that exposure. So guess what? If I have a target beta of 0, the fund should have lower volatility than long-only strategies, and more importantly, my correlation should be lower. I should get more diversification. And oftentimes these market portfolios, they're going to use pair trading. And people get a little confused about pair trading. Let me make this really clear. Let's say you're analyzing the soft drink industry. And let's just say you get a lot of your sugar possibly from Puerto Rico or someplace that's prone to hurricanes. So what's going to happen here? Maybe you like Pepsi because they don't get as much of their product from this hurricane high-risk area, and they have other things like food and snacks that they sell, and maybe you want to sell Coke. So they're both in the same soft drink industry, but I'm long Pepsi and I'm short Coke. That's pair trading. So we can do this in a lot of companies. Maybe you really like Apple, you don't like Google or something like that. Okay, so let's talk about long-short benefits. And again, this is different than a long extension strategy because now we can actually express our negative views or our positive views. We're not going to end up net 100% long. We can also use leverage. We can use high conviction materials. I can remove market risk. I can increase diversification. And I think probably the most important thing about this, I can control exposure to risk factors that I'm most concerned with. Okay, and then finally, it's not enough in this industry, and specifically for your exam, remember with all of these strategies, and this is going to be especially important in alternative investments, you can't just talk about the good things. You have to be able to talk about the bad things as well. So there are going to be some drawbacks. So guess what? If I short a stock, that means I'm betting that that stock's going to go down. Well, guess what? If I sell, if I basically go short, the stock could gain potentially unlimited amounts of money. And my cost of borrowing securities can become really expensive, especially if it's just not widely held and there's not a lot of short stocks or stocks that I can purchase to go short. The other thing that's really important, just like anything else with supply and demand, if all of a sudden a lot of people want that stock that I need to go short, I might have to put up a lot of collateral. I might have to pay a lot for it. All of this ekes into my alpha or my expected return. And then the other thing, especially with social media today and so many folks watching CNBC and program trading, don't be shocked if a short squeeze happens. All of a sudden they start seeing, hey, this stock starts going down, people start piling on, all of a sudden you're having a harder time covering this position, and even more importantly, you're having trouble obtaining shares even to go short. So bottom line, we talked about a lot of things in equity today. A few things that I want to summarize. Equity is not a heavily part of the exam. At best, you're probably looking around 5%. And then more importantly, there are so many terms and lists. There are a lot of things in here. I want you to practice as many of the Kaplan-Schweizer questions as you can. And more importantly, dig through these, pick out a couple lists. Think about how you're going to build a portfolio. Think about how you're going to identify risk. And more importantly, I want you to think about this section. Don't just think of it as probably an item set. I want you to think of it and approach it as, what if this was a constructed response? And I always want you to think about, with each of these strategies we talked about, I want you to know positives and a couple negatives. If you keep this in mind, you should be fine for the exam.